This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So the launch of the podcast was, I would say, a success. We recorded our first 3 episodes just as a bit of a pilot to see if anybody was interested. And in our little world, I'd say we had an overwhelmingly positive response.
Feedback's been great. So nice to hear that people are interested, appreciate it, and actually give us a feedback, which we like very much.
Yeah, we did have that.
And maybe at some point we'll have clients on as guests and talk about their situation anonymously. Who knows where this can go? So if you have ideas, send them along.
Yeah, definitely. We'd be open to any ideas like that. We had about 200 downloads of the episodes that we released, which is, I thought it was pretty cool. So anyway, we will continue going with the podcast.
So you're getting lots of questions lately with clients about the bull market.
Yeah.
I don't know about you, but lately seems like everyone raised the issue of what do you do now? How do you invest now? Markets have been so good for so long. Should we do something different?
Right. I think we're about 3 weeks away from this being the longest bull market in history, surpassing that of the 1990s. There's some other stats out there that are interesting. I think the 10-year return on the S&P 500, so that's 10 years to date, is just before Lehman Brothers failed and we had the
Gosh, I remember that weekend. That was unreal.
Yeah, you told me that story.
And it's 10.8% compounded, including dividends. That's in Canadian dollars.
No, that's U.S. dollars.
U.S. dollars, okay.
Yeah. And so adjusted for inflation, Microsoft's 1999 peak value translates to about $950 billion today, so pretty close to Apple's $1 trillion valuation. But anyway, this article was on CNBC. It's kind of pointing at, this looks like then, which is kind of the question I think that you've been getting.
Getting a fair amount. And we had some questions last week. My equities, that's been great. So you've done a good job managing that, but my bond returns have been low. So I'm going to go do something and fix that. And it's like, well, you've experienced higher than expected returns on the stock side, and yes, lower than expected on the fixed income side. But overall, a balanced portfolio has had very respectable returns over the decade.
Yeah. But you're right. That's when people start to get worried about why the bonds aren't performing well, and they forget why they have them in the first place, because we haven't seen big crashes like we had in 08-09.
And there's a lot of investors that have never really seen negative returns.
That's right.
So
yeah.
Maybe for a quarter, which was it 2 years ago we had some negative returns in the quarter?
Yeah.
But to have a prolonged bear market like we had in 2008, which going into 2009, I can remember people saying, just go GICs for now. I have enough in equities, even though the equities had dropped by 20, 30, 40%. People felt they had enough at that point. So there's a lot of appreciation for bonds when things don't go so well.
So did you have any clients back in 08-09? Did you have any clients pull the plug?
I can think of 2.
And they just told you,
partial.
I can't do it.
One was a partial, one was a full transfer out. Had a few people that came into new money then who decided that this equity ride was not for them, and they went to annuities, which in hindsight, the annuity rates were pretty good back then.
Right.
In hindsight, given where interest rates have gone. But I can remember in early 2009 talking about rebalancing into equities, and we had to do it.
Right.
And we did do it.
What were those conversations like?
It would be very different today. Today, I think people appreciate it and kind of know the religion. Back then, it wasn't necessarily as easy a sell per se. I think a lot of people decided that they were less prone to risk coming out of that. So we all know there's recency bias when everyone wants more risk now. The returns have been good. Well, back then returns have been bad, so people wanted to kind of tone down the risk.
Yeah, that's really interesting.
And this is one of the reasons why I'm so happy to have so much money in the DFA Global Balance portfolios, where this rebalancing happens every day, no matter what happens.
There's no conversation about it.
And even look now, yes, it's been a bull market, but not all markets have been that strong. Canada hasn't been that strong. We talked about value underperforming lately.
Right, we're talking about that huge bull market. It's really U.S. stocks.
Really U.S. large cap growth stocks.
Yeah.
And it's a handful of stocks have driven the majority of those returns.
Yeah.
So to know that we have a value tilted and a small cap tilted global portfolio where you're being rebalanced every single day in the 14 sub asset classes.
Yeah.
This is the message I give to people. Say, yes, there's been a bull market in the U.S., but there's not been a bull market everywhere. So the strategy made sense before, it continues to make sense today. So just keep on doing what you've been doing.
Yeah, there's that great stat on the lost decade in the U.S. where there were the 10-year period from, I think, 2000 to 2010, where if you were invested in U.S. stocks, you actually lost money. You would have been better off in T-bills. But then you add in global diversification and small cap and value and all those different things, and you actually had great returns.
Yeah. Well, Eric Nelson does a great job of hammering those numbers at Servo Wealth Management. Maybe we can put that in the show notes. He puts out great data on the lost decade.
Yeah, he does. So speaking about market volatility and stocks decreasing in value, one of the things that happens from a portfolio management perspective when assets decrease in price is something called tax loss harvesting or tax loss selling. So that's the practice of selling securities that are at a loss so that you can actually use that loss to offset a current or future capital gain.
Only capital gain. You can't use it against income.
Yeah, that's right.
A lot of confusion on that.
There was a post on Enterprising Investor, which is the CFA Institute blog, where the author of the post was questioning how effective tax loss selling really is. And he points to a bunch of different issues. I think the most interesting ones are that in order to claim a loss, you can't hold the same security for 30 days. So in Canada, that's called the superficial loss rules. In the U.S., it's called the wash sale rules.
Yep.
But what it means is if you, as an example, just because these are the numbers that I have an example for, if you take VCN, which is a Canadian equity ETF, and sell it at a loss, you can't own that same ETF for 30 days if you're going to claim the loss.
Or a similar one, right?
Well, that's the thing. So CRA has their definition of identical property, which, yeah, so you can't own identical property. It's a pretty legalese definition.
Yeah.
But presumably, and this is the way that people who do tax loss selling with ETFs, presumably as long as you own ETFs that are tracking a different index, that's different enough.
Yep.
At least that's how people are doing it. So you look at something like VCN, you sell it, but then you're not going to not have Canadian equity exposure for 30 days. So you have to find something called a tax loss selling pair, which is, as I just mentioned, a second ETF that tracks the same market without tracking the exact same index.
Sub-index.
So the risk that you're introducing is that the index that you switch out of does better than the index that you switch into over the 30-day period while you're waiting for your loss to materialize.
And I wouldn't do it unless it's a pretty material loss.
Sure.
And there's not many material losses on the books anymore.
But this is a thing. Yeah, you're right. But if we have a crash or a downturn or whatever, then we could have some losses. But that's the thing. If you start looking at more material losses, then you're talking about bigger positions too, right? Which means so that risk,
correct.
That
risk
risk scales
in
up.
proportion for sure.
So I was kind of curious, what does that risk actually look like? So I just looked at the monthly return difference between VCN, so that's the Vanguard FTSE Canada All Cap ETF, and XIC, which is the iShares Canadian ETF. And the average monthly return, I went back to 2015 just arbitrarily. The average monthly return difference is 9 basis points.
0.09%.
0.09%. So you're introducing this additional, average deviation of
for 1 month. So
for 1 month, yeah.
The other thing too is that if you trigger the loss, you can also carry that back a couple of years.
True.
So if you happen to have a big capital gain a couple of years ago, we had this happen this past year, and they had a loss somewhere else in their portfolio, so we were able to trigger that loss and go back.
Yeah, that is nice.
So if you have a big gain 2 years ago, this is the year to trigger that loss. If you have any, to go back and mop up some of that.
If you have losses. This becomes more of a relevant conversation if we have a downturn and people have losses. But even now, stuff's been going up for such a long time, it's going to be tough to have losses unless you're adding in new money now or on a monthly basis, I guess. The other big things about tax loss selling are that it depends very heavily on your current and future tax rates. So it's all about a tax deferral where you can use the loss to offset a gain now, but you're also buying your security back at a lower cost base when you sell it, which means you're going to have more tax to pay later. So you're still paying the tax, you're just paying it in the future. Right. So you're benefiting from the deferral. That deferral is only beneficial if you're in the same or a lower tax rate in the future. And obviously future tax rates are a complete unknown. So this is one of the challenges with tax loss selling, is that because we don't know what future tax rates are going to be, either on a macro level or at each individual level, that makes the pitch that tax loss selling is a guaranteed way to add value. Well, I mean, it's not, but it is still an interesting strategy.
So this whole topic of zero fees has caught your eye, hasn't it, this week, and certainly caught a lot of people's attention on Twitter. So there's a domestic story as well as a story in the U.S. about the drive towards lower fees. So the Horizons.
Well, I don't know if the Horizons one's an actual story about low fees. They wanted it to be.
Well, the story was out there anyways. So they claim to have the 0% management fee wrap ETFs, so portfolio ETFs.
And the product's cool. Like, it is. We're going to not slam the product, but the marketing was slammed on Twitter by a few people. So,
pretty harsh.
Yeah, it was pretty harsh. Horizons came out and said that they have the first 0% MER ETF in Canada, which is true. They created a new ETF that has no fee at all, but it holds underlying Horizons ETFs, which do have fees, which the unit holders of the wrap ETFs still have to pay.
Right.
So it's not actually a no-fee ETF, just the big overarching product doesn't have fees, but all the underlying products do. So I would call it a little bit of a misleading marketing. They wanted to get in on the no-fee hype, but they don't actually have no-fee products. But anyway, the products are pretty cool. They're kind of similar to Vanguard's single decision ETF, so you're getting access to a globally diversified portfolio of ETFs by owning one single ETF. They came out with two, HBAL and HCON, so it's a 70-30 portfolio and a 50-50 portfolio, so 70 stocks, 30 bonds, and 50 stocks, 50 bonds. And they're using their own total return index ETFs to create these products.
So they're not paying any sub-advisory fees to S&P or MSCI or somebody?
Well, no, I don't know how that works because they're swap-based, but they still track major indexes. Like, they're still tracking the NASDAQ 100.
Yeah, but the fact that it's swap-based. Anyways.
I don't know how that works for the sub-advisory fees. But the investors do end up paying a swap fee. So on the Horizons website, it says the swap fee can be as much as 30 basis points. The underlying fees on these ETFs, so we said that the product has no fee, but the underlying ETFs do have fees. The weighted average MER ends up being between 15 and 16 basis points. But then you've also got the swap fee of up to 30 basis points. Now, for an apples-to-apples comparison, if we're going to add in the 30 basis point swap fee, you have to start taking into account the withholding tax on foreign dividends because you're not getting any of that with these total return index products. But if you're using like a Vanguard international ETF, then you're going to have unrecoverable withholding tax, especially because I think the Vanguard products are still holding U.S. listed ETFs as opposed to securities directly.
Yeah, we should talk about that in a future podcast.
I haven't checked that in a while. I know iShares is mostly holding securities directly now.
As does DFA.
Yeah, DFA.
So you get the full credit for any taxes.
Yeah. That's one of the really cool things about DFA. And that put DFA ahead of the ETFs for a while, but the ETF providers, potentially spurred by our colleagues Dan and Justin, I don't know if they have that much pull in the industry, but they made a lot of noise about withholding tax, and the ETF providers have.
But the point is,
responded.
the fees are coming down. It's a price warfare out there, and the one decision tools for individual investors are increasing all the time, which is good.
I hope that this new Horizons product spurs someone like iShares to launch something similar. I think it's great that Vanguard did it. I wouldn't touch this new Horizons product, personally.
Yeah, I mean, I'm not the biggest proponent of them, and I mean, I'd love to know how much money's been lost on their leveraged and inverse leverage ETFs. I guess we looked at
they had a managed futures product a while ago, which I wrote a post about that a couple weeks ago. I wouldn't touch that as a strategy anyway, but Horizons did have a product like that, and it closed down because performance was so bad. That's not their fault. That's just managed futures happened to do poorly while that fund was open.
So the other zero fee story was Fidelity, which is the huge company out of the U.S., $2.5 trillion of assets under management. Believe their main bread and butter is on the active management side. Huge fees generated there.
Active management, they've got brokerage, they've got financial advisory. 2.5 trillion, just to put it into context for our Canadian listeners, the Canadian mutual fund industry as a whole is like a little bit over $1 trillion.
Right.
And ETFs they don't add much to that. So 2.5 trillion USD is substantially bigger than the whole entire Canadian investment fund market, including mutual funds and ETFs.
So they are truly not charging a management fee on their index, and I know there's no sub-advisory, like no S&P fees, no MSCI fees. They have their own index, that saves them probably 3 to 5 basis points there. But you got to follow the money. They're not doing this for nothing.
Yeah, so speculation is two things. One, that they're going to get sec lending revenue, which everybody's getting. And there was an article written, I think it was either by Vanguard or about Vanguard, probably a while ago, 3 or 4 years ago, where the author of the article, I don't remember who wrote it, but the author wrote that ETF fees will eventually go to zero because of sec lending.
Okay. What is sec lending? We can't just fly over that term.
Sure. So when an ETF has assets held in trust, they can lend those assets out, and they receive a fee for lending the assets out.
So who would want to borrow that asset?
Short sellers.
Because they think the stock's going to go down. They borrow from you, pay you a rent, fully collateralized rent. So there's very minimal risk to the unit holders of the Fidelity fund or whatever fund it might be.
Yeah, I mean, it's very, very little risk.
It's very common in the industry to generate sec lending fees by lending out these shares to hedge funds, I would presume, who want to short a stock.
And everybody's doing this. And with MERs as low as they are now, I think in a lot of cases, fund companies, so that's the iShares, the Vanguards, probably the Fidelities too, with their index funds anyway, they're getting more revenue from sec lending than they are from their actual MERs because MERs are so low. The interesting thing about fees going to zero, I think, is that it doesn't really matter. Like we look at ETFs now, they're 10 basis points, 5 basis points. Going from 5 basis points to 0 basis points doesn't really matter.
No.
It sounds nice, I guess.
We've already dropped 95% of the old fees anyways. But you can only get that fee if you buy directly from Fidelity, I believe. You have to buy it on their website or through their service.
Right. So
if you want advice, there's going to be an extra margin for the advice.
Well, that's right. So I mentioned two things that they're probably doing this for. One is the sec lending, or that's where they're going to get revenue from. The other one is exactly what you're saying. It's a financial advisory.
But look at what this is costing them. I found the data point. So they've picked up $36 billion so far this year in their passive index type products, but they've lost $27 billion of active funds this year. They've been transferred out. I mean, that's a massive hit on revenue.
Yeah, that's where all the revenue is coming from. Absolutely.
So I'd love to know how much that sec lending fees are actually shared with unit holders. I guess we could dig into their filings to find out. I don't know what their policy is.
Once they've filed, I don't know.
Because some companies share that revenue with unit holders.
Well, somebody wrote about that this week too, or last week. Was it this week? Anyway, somebody wrote about how we might get to a point eventually where ETF companies are actually paying unit holders to own the funds. So if the MER is zero, and there's sec lending revenue that's going back to the unit holders, you're ending up with a negative MER where you're actually getting paid to own the fund in excess of the investment return, obviously.
Well, we know in the DFA world, you can look at their filings and see how much sec lending revenue is generated for unit holders.
Any company. You can look at it for iShares.
I've never gone back to see what it is as a percentage compared to...
It's very close. I looked at iShares and DFA a few weeks ago. It was very close. DFA does, they've negotiated more of a payout. So there's a fee that the fund company has to pay to lending agent, and DFA gets to keep more of the revenue. iShares ends up paying out more to the lending agent, and they act as their own lending agent. So they're kind of splitting it with you, I guess. DFA has to pay it out to RBC, I believe, is their lending agent.
Yep.
So they've managed to negotiate a little bit of a better split for the fund holders than iShares has.
So one of the giants of the indexed fund industry spoke up last week on the Capital Allocators podcast that you discovered.
Yeah, it was a good episode. So it was Charley Ellis. He's been around for a very long time. He entered the investment industry in the 1960s, and he's in his 80s now and still working. And that's one of the things I actually talks about in the podcast is that this financial services and investment management is such an attractive business to be in, and it's a business that you don't have to get out of. So he talks about that as one of the reasons that he doesn't think active management will go away. But that's beside the point of what I want to talk about for this bit. So he was talking about the things that have changed since he started in the investment management business in the 1960s. And these are all things that make it harder today for active managers than it's ever been in the past. Not that we need more convincing of why passive makes sense and active doesn't, but these were pretty interesting data points.
No, because so many people say the debate is over. And frankly, I don't really do the debate anymore with people. People that we meet kind of get it. It's so logical. And our appetite to try to change people's minds is virtually nil. So,
yeah. Yeah, the interviewer for the podcast, he is actually a consultant, and I think he does have some beliefs around active management. So he made some comments to Charley, basically saying that he does believe there are some good managers, but that's his own problem. Like, that's his own bias. So he kind of recognizes that he's probably wrong, but still has those beliefs. Anyway, so Charley says that in the 1960s, about 10% of trading at most was done by institutions, and 90% of trading was done by individuals. And the way that he describes on the podcast is quite funny. He says, who were those individuals? They were nice people. So they're people investing their savings in stocks, not doing a whole ton of research, maybe reading the newspaper. So if we think about the world of active investing, you need to have people to exploit. You need to have people who are making bad investment decisions. I think Charley calls them willing losers in the podcast. So back then, sure, maybe if you're an active manager, there are willing losers to exploit.
But you had no technology either back then to get the information.
Sure, true. You think about an active manager, they might have more resources than the guy coming home from work, reading the paper and buying some AT&T shares or whatever he was buying.
Yep.
So today, Charley says, and I didn't find anything to back this up, but we'll take it for what it is. Charley says that 99% of all trading today is done by computers, and most of the investors behind those computers are highly skilled and have instant access to information. So another way of looking at that is that back in the 1960s, there were a lot of easy people to exploit. And today, that's not the case. There's nobody to exploit.
There's no dummies on the other side of the trade.
Right. In the past, it was possible for an analyst to set up a private meeting.
I love this.
Yeah, it's so interesting.
Remember those ads you see on TV where the manager would fly around the world to meet management?
Yeah. So you used to be able to do that, and the management would actually give you information that maybe wasn't public yet. But I think it was in 2000, I believe, that Regulation FD in the States, I'm sure we have a Canadian equivalent. I didn't look into what it's called. But the SEC now requires that any material information that is disclosed to an analyst or whatever must be disclosed publicly. So under Reg FD, it is not possible legally to get a competitive information advantage. So no matter how good your technology is, even if you had a way to get an edge, you can't. You can't have it. Charley estimates that in the 1960s, there were less than 5,000 people in the active investment management business. And today, he estimates there are over 1 million. Pretty crazy. He also mentioned CFA charter holders. I looked at that number. There are 154,000 CFA charter holders in the world today. Not all of them are necessarily in investment management, but still, that's a whole lot of people.
But you think of these asset management firms like Fidelity, like their revenue is enormous. Whatever technology a manager wants, for sure they can acquire.
Any good manager.
All the best people they can get. They make huge salaries. Think of Goldman Sachs. Think of all these different companies. That's pretty fierce competition, pretty fierce price discovery.
Well, it's the whole thing about the paradox of skill. So this is a case, and it happens in other things too. In one of our previous episodes, we talked about LeBron James playing one-on-one against himself and how those games are going to be won by luck, not skill. It's the same thing in investment management. You get more and more skilled people with better and better information, and it just gets harder. It doesn't get easier. It's not good for investors who are investing in active funds. A couple other points that Charley made. Back in the 1960s, a securities firm, would have 10 or 12 analysts, and those analysts weren't researching on behalf of their clients. They were researching to find good investments for the partners of the firm, so trying to find some good small cap stocks to make a profit on. And they weren't publishing their research. So they'd go and identify a great company, and they wouldn't publish their research. They'd bring it to the partners, and the partners might invest. Today, securities firms, which there are many of, have hundreds of analysts all over the world. And they've got all sorts of different expertise. You've got economists, you've got behavioral economists, you've got financial analysts, whatever you can think of. And they're publishing their research constantly.
Exactly.
So that makes it, again, just harder to have an information edge. And the last point that was kind of interesting, back then there were about 3 million shares traded each day. And today there are more than 5 billion shares traded each day.
Over 80 to 100 million trades per day.
Yeah, 85 million trades.
And you just go look at the ticker in our office here to see trades go through in a different stock. It's just mind-boggling how many and how fast they go through.
And like Charley says, a lot of that's going through algorithms.
Yeah.
So even though people are initiating the trades, it's being processed by algorithms. I thought it was interesting to point out, too, that the SPIVA report, which Standard & Poor's puts out twice a year, it kind of backs up this whole idea that...
Every year it backs it up. It never changed. This story has never changed.
Yeah, we've looked at the report all over the world, too. I think that Ray, our director of research at PWL, is actually going to start doing sort of a wrap-up of all the SPIVA reports to look at how it looks globally. But you look at 10-year performance, so Canadian equity mutual funds who are trying to outperform the S&P TSX Composite Index, 8.14% of them have been successful. So about 92% of funds failed to outperform the index over 10 years.
Either didn't outperform or they just shut down in the past 10 years.
Right. True.
8% of the funds that were here 10 years ago in the Canadian marketplace beat the Canadian index.
Yeah. I don't have the stat in front of me, but I've looked at it fairly recently. I think it's about, overall, across all fund categories, it's about a 50% survivorship rate over 10 years.
Look at the global equity numbers. 2.45%
Yeah.
of the funds that were here 10 years ago beat the relative index.
Yeah. Look at U.S. equity, 1.67%. Why people still invest in active funds is beyond me.
Yeah.
There was a neat interview by CFA Institute with Danny Kahneman. This was earlier this year. It's not new, but I saw it for the first time recently. So Daniel Kahneman is a behavioral economist. He kind of fathered that whole...
Wrote the great book, Thinking Fast and Slow.
Yeah, Thinking Fast and Slow.
Just
that's
a
right.
great book.
So behavior is often cited by active managers as sort of a reason that they can beat the market. So they can predict investor behavior, herding behavior, and things like that to produce an edge. And I thought it was pretty funny. The Kahneman said in the interview, all behavioral economists are against active investing because they think the market is unpredictable or very, very difficult to predict. So the guy who fathered behavioral economics is saying that you can't use it to invest actively to produce consistent outperformance. He also talks about intuition in stock picking. So you'll talk to someone who maybe they have had a successful career in stock picking, but Kahneman basically says you cannot have intuition in stock picking because markets are random. If you have intuition, you've got your own biases.
Based on your own experience. So
Basically,
if your experience was successful, you'll take that intuition as being strong and start relying on that.
Right.
But it's not a good decision.
That's right.
He was pretty emphatic in that interview.
Yeah, he was. He does mention that in venture capital, maybe you can build intuition. But in any efficient market, so any liquid...
Right. Because you can add value in the venture capital world. You can't add value in capital markets.
Right.
Anything by Danny Kahneman is worth reading, worth checking out.
Yeah.
For sure.
Definitely. Touch on briefly the Sears pensioners. They've had their payments cut by 30%, which was actually more of a cut than they were expecting. That's going to go for 20 months. I think they had a bit of a clawback. But the pension is about 80% funded. So over the long term, they would expect to get about 20% unless they win in court and get that funded. So Sears filed for bankruptcy protection in June 2017. The pensioners lost their health benefits at that time. And now they're fighting to keep to get more of their DB pension plan topped up in the court proceedings.
Yeah, and most people in this town have a DB plan from
The
either
government.
federal or provincial governments, so those would be a different level of safety, of course. But
Yeah.
we all lived through the Nortel, many Nortel pensioners in town that lost some of their benefits.
Yeah, we've seen a lot of that. So it is a bit of a cautionary tale that even if, assuming it's a corporate defined benefit pension plan, which there are less and less of, but even those, I mean, you think about it, a corporate DB pension plan is kind of like a bond. It's being along a bond.
But it's a huge liability to the company.
Well, that's what I mean. It's a big long bond in the company. They've got to make their payments.
That's right.
But if the company goes under and they don't have any more capital and the pension's underfunded.
But there's so few private company DB plans anymore. Everyone's gone to DC to find contributions,
Yeah.
if at all.
Yeah. Fisco does a report, Financial Services Commission of Ontario. They do a report quarterly on the funded status of pensions in Ontario. As of March 31st, which was their last update, the median funded status was 95%. So, I mean, pretty good.
Yeah.
Even if those companies went under and could no longer make contributions, the existing pensioners would be okay.
So that's a wrap for this week. Anybody has suggestions, send us a note.
Yeah.
Put in the comments down below or drop us a note directly.
Yep. I can always be reached by email, bfelix@pwlcapital.com. That's it.
Terrific.